Hello, everyone. My guest today is Steve Benson. If you haven't heard of him before, he's the CEO and founder of a company called Badger Maps, the number one route planner for field salespeople. His career has been in field sales with companies like IBM, Autonomy, and Google, becoming Google's enterprise top performing salesperson in the world. In 2012, he founded Badger, helping salespeople be more successful. Steve, are you ready to take us to the top?
Let's do it. How's everything going with you, Nate?
I am going well, or everything is going well. I appreciate you asking. Talk to me about the company. So I want to get a quick update on where the company's at, but I really want to spend a lot of time in this episode focused on how you're using venture debt to keep more of your company, but still fuel growth. So tell people real quick that are not familiar, what does Badger Mapping do?
So we help field salespeople, outside salespeople. So for people that don't have a sales background, that's the types of salespeople that do their sales face to face. So they go out into the quote unquote field as opposed to selling over the phone. We have a suite of products that help that end user. Effectively, we help them build routes, understand where their customers are in their territory, focus on the best customers, design a schedule for themselves when they're in the field. Meaning if you had 800 dentists in the Bay Area that you were selling to, we help them figure out, well, which 10 should I see tomorrow and which 9 should I see the next day and 11 should I see the day after that, given that I have to me a route that makes sense.
Now, we're recording today. It's October 2018. Last time I had you on was about a year ago on September 8th, 2017. And in that episode, you shared you had about 5,500 customers at about a $35 a month average revenue kind of per user. And that obviously puts you at about $180,000 per month in revenue at that point. Give us a quick update on those numbers.
Yeah, I mean, it's I'd say we've been growing at about 40% year on year. I think we're around 7,000, maybe 7,500 customers now in terms of end users. So yeah, revenue's gone up accordingly. We're doing about 3.1 in ARR now.
That's great. So that comes out, what does that come out to? 258 grand per month, something like that?
That's quick math, Nate, but yes.
Well, pattern recognition. All right, so 250 per month, something like that. 7,500 customers. Has ARPU increased or still about $35?
It's increased a little bit. We have people that try out the product on an entry level product, basically, kind of with some limited functionality. That's about $9 a month, and then we have customers that buy for a company. It's obviously a lot higher. So as we've shifted more and more towards company deals, as we grow, people that we're using for one license, maybe it grows into their team using it or their company using it.
And logo churn per month, still about 3%?
Yeah, I'd say 3.5. So it's been pretty. I guess it's been pretty stable at around that. I think it's been 3.5 forever. But
yeah, that's pretty good. And then you launched obviously in 2012. Last time you were on, you had about 55 folks. What are you at today in terms of team?
I guess we're probably about 60 people today.
Okay. 60 folks, and still heavy towards engineering.
Yeah, pretty split. I guess.
Okay. Everyone in San Fran or no?
No, we're spread around the world in different places.
All right.
But we're headquartered here in San Francisco.
San Fran or remote. Okay, good. That helps us get like the quick numbers on the business. And now let's focus on the venture debt side of things. So last time you were on, you had said, I believe, correct me if this is wrong, but I think you said you'd raised about $450,000 at that point. Was that venture debt or that was the equity you'd raised?
That was, so, I think last time I was on, and I forget the exact date, but I believe we would have been talking about venture debt. We've also early on did about $400K in convertible notes. That was probably in 2013 or so. So we had raised about 450 in debt, and now we're at around 800K in debt.
So walk us through how that works.
Sure. So companies that make loans, that are specialized in making loans to SaaS businesses, tend to look at your revenue as the main driver of determining how much they want to loan you. How much of their money is safe. Lenders are never in the business of not being paid back, so they like to look at things like, oh well, how much how much are you making, and therefore how much debt can you service. So as our revenue has grown, and they look at it really on an MRR basis, they'll give you a multiple of that MRR. And the debt provider that we're working with, I think that they kind of draw the line in the sand right around 4x. So, as you grow, you're able to take about 4x out as a loan. And so if you add 50 grand to your MRR, you can pull out another 200 grand in loans.
And how do you pay that back typically?
Well, that's a great question. And the answer is it depends. You have a couple options depending on how the debt's structured. One, you can pay it back as a percentage of your revenue. So like your first, if you were making 100 grand a month, maybe your first 50K that you bring in a given month, you pay 9% of, and the second 50K that you bring in per month, you pay 4% of. And so if you have a great month, you pay a little more. If you have a crappy month, you pay a little less. And that's a revenue-based loan. They can also structure it as a straight line loan, which people will be more familiar with, where it's more like a loan on a home, where it's like, oh, your payment is $5,000 a month over 60 months.
And just to be clear, if you do the revenue-based one where it's kind of goes up and down with your revenue, what's the percentages that you're typically kind of ranging between? Is it 4, 5, 6, 9, 10% of monthly revenues? What is it typically?
I think it depends on your growth rate and your size. It'll change what they'll be willing to underwrite based on the risk that they're willing to tolerate. The more stable or the faster growing your business is, the lower your churn is. And these guys, the lenders that are focused on making loans to SaaS businesses, they look at these all day, so they know exactly what to look for. They'll make those numbers a little different. So I don't know the exact ranges that I would imagine that it's between 7 and 12% of your monthly revenue, depending on where you're at and where kind of they draw the lines in the sand. I mean, I guess a more important number to think about is what's the rate that I'm paying? Is it? And I think that's going to range with the different lenders between 14% and 30%, depending on who.
What do you mean the repayment cap?
Not the cap, but so that's a different way of looking at it, and we can talk about that in a second. Let's just define that really quick. Repayment cap meaning that the amount of money that you're going to pay them back over the period of time, regardless of how fast it takes you to pay them back, you're going to pay a percentage of revenue until it's paid. So meaning if you borrowed $100,000 and you were going to pay them $150,000 over 4 years, the repayment, that's a 1.5 repayment cap. So whether you paid them back in 3 years because your revenues grew fast or 4 years because your revenues grew as expected, then you're still going to pay them 150 grand. It's just based on where. So the faster you're paying them back, the higher their return on invested capital is.
The IRR goes through that. That's actually one of the hits on venture debt is exactly that, which is the effective IRR. If you do use it to grow, can be really high for it's really actually expensive capital. Now, the flip side of that from a founder perspective would be like, well, yeah, but it took no dilution and we drove a lot of growth with it.
Yeah, I mean, they are getting a great deal if you grow really fast, right? If you grow faster than expected, they get a great deal. But the argument there is you don't care because you grew really fast, and your downside's protected on it a bit because should you grow slow, you end up paying them back slowly. And so it's nice. A lot of the way the revenue-based loans that these lenders are using, I think, tend to be well aligned in that regard. They are expensive compared to, what you'd pay on a home loan or something like that has collateral. But the debt tends not to be personally guaranteed, at least in my experience with the different lenders.
And see, by the way, I want to point out, I mean, we can talk about the lenders. You're using Lighter. They love you. I think you love them, right? That's who you're using mainly?
Yeah, so that's the only institutional investor that we have. Yeah,
for Lighter Capital.
hmm
Yeah.
But I'm also familiar with a bunch of them because I've talked to a bunch of the different players. But Lighter Capital is the one that I chose to go with.
So why did you choose Lighter? You don't have to name specifics here, but in generally, why did you choose Lighter over SAS Capital, Timia, or Hercules? I mean, there's a ton of these recurring revenue partners.
Yeah, there's a whole bunch of them. In general, they tend to be going after companies that are making the ones that you just listed. They're in my experience going after companies that already have an MRR of 3 to 5 million, and some of them more than that. And so we went with Lighter Capital because when we got our first loan, I think we were making around 50, 60 in MRR.
Yep.
And so those other players weren't even in play at that point.
And Lighter, some of these other guys, they do have covenants and warrants. Does Lighter have any covenants or warrants?
No warrants at all. And just so people know, a warrant is basically a stock option. It's another way of saying it's another type of stock option, basically.
Yeah. So explain how that works, for people not familiar.
So they'll end a warrant basically gives them the ability to own, 0.5% or 1% or 1.5% or whatever the warrant is for of the business.
Based off what price?
That's a good question. I think it works like an option where there's like a strike price. So it's whatever the fair market value was when you actually took out the loan.
Yep. That's how I'm familiar with them working, at least. Very good. Anything that any downsides where you've taken the money, you've gone, anyone else who does this, just watch out for this one thing. It surprised me.
Well, that's a good question. Let me think. Because there are definitely a whole bunch of gotchas.
Yeah.
The hardest thing is calculating actually what does this cost me from an IRR perspective. Like what is the interest that I'm paying on this loan with a revenue-based loan is difficult to calculate. And
it's extremely difficult.
Modeling that was, maybe I just suck at this, but modeling that was actually really hard for me. But I eventually figured it out. But it's because there's a lot of variables and it's a relatively complicated debt instrument. It was hard to figure out exactly what the price was. And they're not going to tell you. So, so that's definitely one. I feel like there should be some other pieces of advice I should give people here.
Let me ask you this. Why didn't you raise $1 million in VC and then go with like a Silicon Valley bank, which, typically has lower interest rates. So it's cheaper capital typically.
Yeah, I mean, so Silicon Valley Bank will only make you loans if you're a pretty big company or if you have meaningful venture backing. And I don't think $1 million is what they're looking for. I think they want a meaningful venture backing, and they want that venture capitalist. They're not like personally guaranteeing it or like signing on it or anything, but they're kind of like. It feels to me like there's an agreement in place. Like, you guys aren't going to let these guys default on their debt, right? Okay, we do this all over the place. Like, so it's almost more the venture capitalist is vouching for you, and because so Silicon Valley, like, I can't just go to Silicon Valley Bank though at $3 million in revenue and be like, hey, could I have a loan? I'd love a 6%. Loan. That'd be great. They're like, no, we don't do that.
The reason I ask is right now you said you're doing $250 a month. If Lighter taps out at 4x MRR, so your max there is $1 million they can give you, and you're, I think, already at 800 or 900. You said if you want to keep 800. Using 800, if you want to keep using venture debt, the question is like, well, do you go to another firm? I do know Lighter Capital is the only one that will sub under. They'll take a second position under an SVB or one of these other guys. I don't know anyone else that does that.
They'll go under a bank. I guess that is a good gotcha right there. It's important that you make it so whatever debt you're getting can be bought out. Meaning, just like you can refi a home, you want to make sure you can refi this debt and that you're not wedded to it and limiting yourself by it. So you need to have the term in place that you can get out of the debt. Meaning, if you go to let's just say you do a deal with one of them, and then later on you want to do a deal with a different one of them, you want to make sure that the second one can buy out, buy and pay off the first one. If you're doing it on a cap model, you would have to pay the equal amount. To buy them out, you have to pay the price of having the debt the whole time. But if you're on a percentage rate model, then or if you can convert to a percentage model, then you can get out of the position and let a new lender come in who's maybe more attuned to your current size.
Yep.
So that's an important term to negotiate when you get venture debt, I think, is to be able to make sure that you're able to not be locked in to one lender, just like you wouldn't want to do a deal on your home loan with Bank of America that wouldn't let you refi with Chase.
Yep.
But that's a challenge with that. Doing it in the multiple way is you basically have to pay for your full mortgage with Chase. If you bought $1 million house, you pay 1.7 million or whatever is the cap over the course of the loan. You don't want to have to pay the 1.7 million to refi with Chase or with another bank, right? So you want to just be able to buy it out with up to that point. And that's a negotiable term.
And the reason you do all this is because, again, you're preserving kind of equity in the company. So do you have co-founders or just you?
Yeah, I have a co-founder. I guess it's not just about preserving equity. I mean, if equity is accretive, you'd want a smaller piece of a bigger pie, but equity is not, isn't appropriate for a lot of SaaS businesses, which meant because if you're a high growth SaaS business, for you, even though it's expensive debt, it's a really good deal if you can put $500,000 to work, and the investment, the engineers and the salespeople and the customer success people, the marketing, whatever it is that you're buying, pays back pretty quickly. Then then it's worth doing, even though it's expensive debt. So an example here would be if you're going to borrow $1 million and it's going to cost you $25,000 a month, just for example. But if you could put that money to work over the course of a year, and those investments that you made were going to yield $25,000 a month, then those investments just paid for themselves after a year. So you're making payments free and clear, basically, and you still got the assets, right? You still got all those people. You got the 10
sense.
extra employees that you're growing. And if you're a fast growing SaaS business that's capital starved, which a lot of them are because they're not the best fit for VC, because they're not growing fast enough, or they're not going to be a $60 million or $120 million business in 7 years, they are not a fit for the SaaS model, the venture model. Then this is a really good way to get a cash starved business, a capital infusion, and your ROI. If you're making $25,000 a month off of that $1 million, your ROI was 100%. It basically paid for itself.
Yep, you got it.
You're free and clear.
Guys, there you have it with Steve. Crash course in venture debt via his company, Badger Mapping. Number one thing for route, what we call it, route optimization for on the road salespeople is how I describe it. Steve, thanks so much, man, for taking us to the top.
Absolutely.